Is this stock a falling knife, a screaming sell signal, or is it secretly the most undervalued AI play on the market right now?
It is basically the absolute ultimate market paradox. I mean, you are looking at a company undeniably at the center of the global AI revolution, but, well, it's currently fighting a brutal multi-front war just for its own survival.
Right. And the stock we're talking about today is Supermicro Computer Inc., better known by its ticker SMCI. Just to give you listening a taste of the sheer stomach-churning volatility we were looking at, um, this stock had a 52-week high of $62.36.
Yeah, and recently it crashed down to a brutal 52-week low of $19.48.
Oh man, it's just between your morning coffee and your afternoon commute, entire fortunes have literally been wiped out.
That is a staggering destruction of shareholder value in a very short window. And what's fascinating here is that the market right now is wildly divided on what happens next. Like, just looking at the board today, the stock is sitting at $26.45, up 4.71%.
Which, sounds like a nice little green day on the surface, but it masks a massive underlying structural crisis. So today is April 14, 2026, and our mission in this deep dive is to unpack a mountain of recent data, news, and charts to figure out exactly what is happening under the hood.
Absolutely. And as we unpack this, a quick reminder for you listening, this is an educational deep dive featuring a natural human debate about market mechanics. We are absolutely not giving you any financial advice today.
Right, always do your own research.
Exactly. Our goal is to help you understand the forces moving the chart, not to tell you how to manage your portfolio.
And hey, if you get value out of this deep dive, you really need to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you leave a comment with your feedback on this debate. We want to hear where you stand.
We really do, because before we can even begin to predict where this stock is going, we have to look at the exact moment the floor fell out.
Yeah, let's go back to March 20, 2026. SMCI experienced a massive 33% single-day plummet. I mean, a literal third of the company's value vanished.
And it is crucial to understand that the market didn't panic over, like, a missed earnings target or a delayed product line. This was a crisis of fundamental corporate governance.
Right, the legal news.
Yeah. The news broke that an SMCI co-founder was formally charged with conspiracy to smuggle hardware to China.
Now, obviously, we are not taking sides on the legal merits of the case here. We're just looking at the facts of the market reaction. But man, you hear smuggling hardware to China in the current geopolitical climate, especially regarding high-end AI tech, that isn't just a bad PR day.
No, not at all.
That is an existential threat to the company's supply chain, isn't it?
It absolutely is, and that is exactly why the institutional money fled the stock so violently. Because if you are a massive fund manager, you can model for margin compression, right? And you can model for supply chain delays.
Yeah.
But you cannot mathematically model for criminal conspiracy charges at the highest level of leadership.
Yeah.
And let's talk about the mechanism of that fear. Why did they sell?
Well, because if a U.S. tech company is found guilty of violating export controls on high-end hardware, they risk being placed on restricted entity lists, right?
Precisely. Which means the U.S. government could legally lock them out from buying the very components they need to survive. If they can't buy NVIDIA chips, they literally can't build AI servers.
Oh, wow. So it doesn't just hurt their profit margins. It has the potential to shut down the entire assembly line.
Exactly. That kind of headline triggers automated, algorithmic risk management sell-offs across Wall Street.
Yeah.
They dump the stock first and ask questions later.
Which is exactly how you establish a brutal new 52-week low of $19.48, literally days after the news broke.
Okay. Let's unpack this, because here is where the disconnect gets completely wild.
Oh, the financials. Yes. If you look away from the police blotter and actually look at the company's income statement, it feels like you're looking at a completely different, wildly successful business.
It really does.
We have their Q2 fiscal year 2026 numbers here, and they are eye-watering. Net sales hit a massive $12.7 billion. That is up 123% year over year. They more than doubled their revenue.
The top-line growth is undeniably spectacular. They are capturing the tidal wave of AI infrastructure spending.
Right. And the bottom line looks solid at first glance, too. Net income rose to $401 million. Diluted earnings per share, or EPS, is sitting at 60 cents under standard GAAP accounting rules.
Or 69 cents non-GAAP, meaning if you strip out certain one-time corporate costs. So on paper, they are selling AI servers faster than they can build them.
Yeah, but this is where we have to read the fine print, because that same income statement reveals a terrifying structural problem.
The margins.
Exactly. A year prior, their gross margin was 11.8%. Today, It suffered a massive compression down to just 6.3%.
That is a brutal squeeze.
I was looking at that exact number in my notes, and I want to run an analogy by you. To me, looking at these numbers, it's like a restaurant that suddenly doubles its footprint, doubles its daily customers, and doubles its revenue.
Okay, follow.
But they are making literal pennies on every single meal because the ingredients suddenly cost an absolute fortune, and they are too terrified to raise the menu prices because a massive, wealthy diner opened up right across the street.
That is a perfect way to visualize the mechanics of their margin compression. In the AI hardware space, the ingredients are incredibly expensive, highly sought-after components.
Like the GPUs and the cooling systems.
Specifically, the latest GPUs and the advanced liquid cooling manifolds required to keep those chips from literally melting down. SMCI doesn't dictate the price of those GPUs, their suppliers do, so their costs are skyrocketing.
Right.
And at the same time, competitors like Dell and HP are aggressively pricing their own server racks to capture market share.
So SMCI is voluntarily slashing its own margins to offer competitive pricing. Like, they are choosing sheer volume over profitability just to stay relevant in the fight.
Exactly. But what's fascinating here is how this specific strategy aggressively distorts their cash flow.
Yes. Let's talk about the cash flow paradox, because this baffled me when I first read the balance sheet. How does a company pull in $12.7 billion in quarterly sales but report a negative $24 million in operating cash flow?
It sounds impossible, doesn't it?
Yeah. How does $12 billion come in the front door, and yet the actual cash generated from their daily operations is bleeding in the red?
It all comes down to the physical reality of what they are building. When you are constructing cutting-edge, liquid-cooled AI racks at a massive scale, you cannot build them out of thin air.
You actually need the physical parts.
You have to secure the chips, the miles of copper piping, the cooling fluids, the chassis, all of it up front. And because global demand is so relentless and these components are so scarce, SMCI has to lock up billions of dollars in inventory before they ever deliver a finished server to a customer.
Oh, I see. So that cash isn't actually missing. It is physically sitting in warehouses in the form of raw metal and silicon, just waiting to be assembled.
Precisely. Their cash is trapped in their own supply chain. Add to that the $46 million in capital expenditures, the physical cash they spent to expand their manufacturing facilities to handle this growth.
Right.
And suddenly, despite billions in sales, they are operating at a cash deficit.
And, when you are burning cash on daily operations, you have to look at the balance sheet to see if your safety net will hold. Total assets are listed at $28.0 billion, which sounds highly reassuring.
Very reassuring.
Yeah, they have $4.1 billion in cash and equivalents just sitting there in the bank. But the other side of the ledger is what makes me sweat. Total liabilities are sitting at $21.0 billion, and that includes $4.9 billion in total debt.
And we really need to look at the structure of that debt because a significant portion of it features convertible notes.
Right, and for you listening, it's vital to understand that convertible notes aren't just standard bank loans that you pay back with interest. They are a specific type of debt that can eventually be converted into company stock.
Which is a huge risk.
Massive. If SMCI's stock price tanks and those note holders decide to or are forced to convert that debt into equity, current shareholders are looking at brutal dilution. Suddenly, your slice of the pie gets dramatically smaller because millions of new shares just flooded the market.
If we connect this to the bigger picture, that $4.9 billion debt load is severely limiting their operational flexibility. When your gross margins are sliced in half to 6.3% and you are dealing with a negative operating cash flow, simply servicing nearly $5 billion in debt becomes a very pressing danger.
Yeah, that creates a tremendous amount of internal friction.
Especially when management is simultaneously trying to navigate the massive legal fallout of the smuggling charges.
So to summarize the corporate reality, we have a company experiencing 123% hypergrowth, but with terrible margins, a mountain of structurally dangerous debt, and a geopolitical legal crisis that just nuked a third of its stock price in a single day.
That is the setup, yes.
But here is the disconnect. The fundamentals scream danger, yet the stock is actually up almost 5% today. That cognitive dissonance between the scary fundamentals and the green on the screen is exactly why we need to pivot and look at how the market is actually trading this stock right now. Let's look at the chart.
Well, if you look at the technicals, the trend direction right now is actually a neutral to bullish short-term recovery.
I have to admit, I wouldn't have guessed that.
I know, it feels completely counterintuitive. But remember, the market is a forward-looking mechanism that constantly searches for a new equilibrium after a shock. The stock has rebounded roughly 35% from that March absolute floor of $19.48.
Here's where it gets really interesting, because I want to push back on this 35% bounce.
Yeah.
Is this a legitimate structural recovery signal?
Or a trap.
Yeah. Or are we just looking at a classic dead cat bounce, where retail traders see a stock that used to be $60, see it sitting at $20, and blindly buy the dip, assuming it's a bargain?
Only to get completely trapped when the institutional sellers wake up and resume dumping shares.
Exactly.
I completely understand the skepticism, and frankly, it is warranted. But I wouldn't dismiss this bounce as purely a retail trap just yet. Let's look at the underlying momentum indicators. The 14-day relative strength index, the RSI, is currently at 66.22.
And the RSI is essentially a speedometer for the stock's recent price action, right?
Okay.
It measures the speed and change of price movements on a scale from 0 to 100.
Exactly. Generally, anything over 70 is considered overbought, meaning the price has risen too far, too fast, and a pullback is likely. At 66.22, it is nearing that overbought territory due to this recent 35% rally.
So it's running out of steam.
There isn't a lot of runway left before the trading algorithms start seeing it as too expensive in the short term. However, institutional traders are pointing to a very specific structural setup on the chart right now, a bullish divergence.
Yeah, some traders I follow have been highlighting that exact phrase. Now, the way I look at a bullish divergence, it's like a car rolling down a steep hill, but the driver is slowly starting to pump the brakes,
That's a great visual.
right? The stock's price action might still be making lower lows or just stabilizing at the bottom, but the RSI, our momentum speedometer, is actually starting to make higher highs.
Which tells us what?
It tells us that the underlying selling pressure is exhausting itself, and the buyers are quietly stepping in and gaining strength. Do you see it that way, or is this a false signal?
You've described the mechanics of it perfectly, and I do believe it is a valid technical signal in this specific instance. The aggressive sellers who wanted out after the legal news have largely exited.
Oh, I see.
The selling pressure has temporarily dried up, which is allowing the buyers to push the price up with much less resistance.
Okay, so the short-term traders have a glimmer of hope with this divergence. But if we zoom out to the long-term trend, the chart still looks pretty ugly, doesn't it?
Very ugly. The stock is currently trading around $26.45, which is deeply below its 200-day simple moving average of $39.28.
And the 200-day SMA is essentially Wall Street's ultimate dividing line. It takes the average closing price over the last 200 days and draws a line in the sand.
Right.
If a stock is trading above it, it's in a long-term bull market. If it's below it, it's in a bear market. Being that far below the $39 level indicates profound long-term institutional weakness.
That is absolutely correct. So if you are actively trading this, the chart has very clear physical battlegrounds. The primary support, the absolute floor that the bulls have to defend at all costs, is that $19.48 level.
And if it breaks that?
If the price breaks below that, there is absolutely no historical safety net nearby. It is open air below. On the upside, the resistance levels to watch are $28.74, which happens to be the 50-day SMA, and then a psychological and technical ceiling at $30.36.
And going back to my earlier point about retail traders getting trapped, even with the bullish divergence, why is this specific technical setup so uniquely dangerous for the average investor listening right now?
Because retail traders often underestimate how fast market sentiment can violently shift when there is an unresolved existential legal crisis hanging over a company.
Yeah, that makes sense.
You might see the bullish divergence on your screen. You might successfully ride the momentum up toward that $28 resistance line. But in a stock with this level of extreme volatility, a single leaked document from the Department of Justice or a single negative press release regarding the export investigation can utterly destroy short-term technical momentum in a matter of milliseconds.
Wow.
Retail traders get trapped because they are playing by the rules of technical analysis, while the massive institutions are trading the existential headline risk.
That dynamic, the battle between mathematical momentum and existential fear, brings us perfectly to the core of the great debate happening on Wall Street right now.
The valuation debate.
Yeah. The technical chart shows a massive tug of war, which perfectly mirrors the divided opinions from analysts. We really have to step back and ask, is this stock a deeply undervalued gem hiding in plain sight, or is it a value trap waiting to spring?
Well, let's look at the consensus from the people who cover this stock for a living. Right now, the average analyst rating is a hold with an average price target of $34. That implies a decent amount of upside from where we are today at 26.45, but a hold is hardly a table-pounding buy recommendation. Wall Street is hedging its bets.
But then you look at the raw valuation metrics, and the math tells a totally different story. The stock is currently trading at a trailing 12 months price-to-earnings ratio, the TTMPE, of 19.8x.
Right.
Simply, Walson even ran their cash flow projections and explicitly called the stock significantly undervalued.
And mathematically, they have a very strong point. If you can look past the legal noise, the fundamental bull case for SMCI is incredibly compelling. We are talking about a company that has a dominant, proven position in liquid-cooled AI racks.
Which, by the way, we really cannot understate the importance of. As these AI chips from NVIDIA and AMD get more and more powerful, they consume staggering amounts of electricity, and they generate insane amounts of physical heat.
Yes, they run incredibly hot.
You literally cannot run a modern high-end data center with traditional air conditioning fans anymore. You need advanced liquid cooling, literally pumping coolant directly to the chips. And SMCI is arguably the absolute best in the business at providing that plumbing and infrastructure at a massive scale.
Exactly. The technological shift requires their exact hardware, and the demand isn't theoretical, it is already proven. SMCI has a colossal order book, over $13 billion, just for the upcoming Blackwell Ultra systems.
That is wild.
It represents incredible, locked-in future revenue growth. If they simply execute on those existing orders, an under 20 PE ratio for a company growing its sales at 123% is absurdly cheap. Most AI stocks with that kind of growth are trading at 40, 50, or 60 times their earnings.
But I really have to challenge those valuation metrics because the math feels entirely dependent on an environment that might not exist in 6 months.
How do you mean?
Well, a PE of 19.8 sounds incredibly cheap, but that ratio is calculated by taking the stock's price and dividing it by its earnings. The E stands for earnings.
Right.
If this criminal proceeding drags on, and their legal defense fees absolutely skyrocket, and if the extreme margin pressure from competitors like Dell forces them to cut prices even further down to 4% or 3%, doesn't that E just evaporate?
Yes.
Doesn't the earnings side of the equation collapse, making that 19.8 ratio a total illusion?
This raises an important question, and your concern is exactly why the bear case is so dangerous here. It is about the qualitative, unmeasurable risks, completely overriding the quantitative mathematical metrics.
Explain the mechanism of that override, though. How does Wall Street price in a qualitative risk?
Think of corporate government's risk as an extreme insurance premium placed on the stock. It doesn't matter how fast the car is driving or how brilliant the engine is. If the market fundamentally believes the driver's license is about to be permanently revoked by the government, institutional investors will price in a massive structural discount to cover their own risk exposure.
So it caps the potential.
It structurally caps the valuation. That lack of trust, combined with the terrifying gross margin compression and that heavy debt load, is the textbook definition of a value trap. It looks mathematically undervalued based on last year's performance, but it remains fundamentally unsafe to own today.
So how does this tension actually resolve? Because we have laid out the mechanics of both sides, and I want to give you, the listener, a clear lens on what you need to watch for next. Let's break down the timeline, starting with the immediate future.
In the short term, the market is laser-focused on that technical chart. Bullish momentum is currently building, trying to push through that $30 resistance line. But the massive catalyst, the singular event that will likely shatter this current holding pattern, is the next earnings report. It is scheduled for May 5, 2026.
May 5. Circle that on your calendar. Because that earnings call isn't just going to be a standard presentation, is it?
Not at all.
It is where management is going to have to face the music. They will be forced to answer aggressive analyst questions about why the margins are shrinking, where the operating cash flow went, and inevitably they will have to address the legal situation and the status of their export capabilities.
And if they survive that short-term hurdle, the medium to long-term outlook is anchored to a truly mind-bending number. Despite all of this chaos, SMCI management has actually raised their revenue guidance for the full fiscal year 2026 to an astronomical $40 billion.
Wait, $40 billion?
Yes. That projection is driven almost entirely by the relentless global demand for those Blackwell AI servers we discussed.
So what does this all mean? When you take the devastating 33% drop, The looming threat of the smuggling charges, the incredible 123% revenue growth, the negative cash flow, the convertible debt, and this massive $40 billion target. You realize this deep dive is the ultimate showdown.
It really is.
It is an unstoppable wave of global AI demand crashing directly into a corporate hull that might be cracking under immense legal and financial pressure.
It is a masterclass in market tension. The upside potential of cornering the liquid-cooled AI market is historic. But the downside risk of a governance collapse, losing access to supply chains, and unmanageable debt is equally severe.
Which leaves us with a final provocative thought for you to ponder long after this deep dive ends.
Right.
If SMCI actually manages to manufacture those servers, fulfill that $13 billion order book, and hit that massive $40 billion revenue target, will Wall Street simply forgive its legal sins in the blind pursuit of profit?
Or will the sheer weight of its $4.9 billion debt and those looming governance issues drag it right back down to the floor no matter how many liquid-cooled servers they manage to sell?
It is a question that challenges the very nature of how markets assign value to a company in distress, and it is a question we want your answer to.
Definitely.
Do not forget to like this video, subscribe to our YouTube channel, and leave a comment below telling us. Do you think SMCI is a screaming strong buy hiding in plain sight, or is it the most dangerous value trap of 2026? Thanks for joining us, and we will see you on the next deep dive.